been hammered so much,
That's
they
good. Yeah.
reckon it's a turnaround story.
Well, has to turn around sometime, doesn't it? Look, no.
They did say that.
Yeah. No. Well, look, A2, yeah, fantastic story, and I own some at higher levels. So, albeit it definitely should look to go further. Bubs is one of those interesting ones because Bubs was one of those businesses many years ago that was looking to get that SAMR, which is the Chinese regulation for them to be able to sell milk or infant formula into China.
Yep.
Now they still haven't got that, and so hence why. And I think, Koshy, you're right. The focus has changed from China, and I think it's great that they're sort of changing focus to the US because certainly that is a massive market, and their announcement today certainly helped the stock rally on the back of that. But I think this one definitely trades by appointment. So in other words, if it's a good announcement, then the stock will rally. But I think there's some long-suffering shareholders in this one. And I think that is probably a negative until that sort of investor base does turn around a little bit. I think it's moving in the right direction. But for me, I wouldn't be buying it here. I'd want to see some earnings starting to come through. It does, looks picked up a little bit today. But that chart definitely says that there's still further downward pressure. When international people are allowed back into Australia, potentially that might be another catalyst for that because obviously we know the Daigous come in, buy those infant formulas, put in their backpack and take it home. So that kind of stuff I think is something that we could look to, but yeah, it's too early stages for me to get involved in this.
Interesting, because even at these really low levels, because it was Mark Moreland and Scott Phillips who put A2 Milk. Now, they're actually quite a good team on the panel because they're very different. Yeah. Sort of Team Invest, Mark Moreland is all about the Berkshire Hathaway model and very conservative. Scott's a bit more entrepreneurial in his thinking, but both of them agreed. Yeah. A2 had been battered so much, it was still a good business even without China.
Well, balance sheet is better, management has been changed, so and they've had 4 downgrades now, so it has to definitely turn around. I think Bubs probably a little bit more on that side that needs to change its focus or shift its focus away from that China side of things, and that's what they're doing today, and that's why they're getting a little bit of love on the market.
Okay, James, what do you think?
So A2 Milk has had a bumpy ride, but it's been profitable.
Yep.
Bubs has been listed since 2016. It's never made in its current form. It's never made a profit. It's raised capital every year. Yes, they've had some things that are out of their control, the China thing, for example, but they've also had supply chain issues. How's that going to be fixed moving into selling on Walmart's platform? Does that mean there come a big acquisition and therefore another raising? Possibly. I don't know. I don't own either of them. If I had to own one, I'd own A2 Milk. Right. I can't imagine a circumstance in the current
because
financials of
Bubs was seen as a baby A2 at one stage, didn't it? That was the story behind
and their point of differentiating goat milk, those kinds of things.
I'm old enough to remember when Babcock and Brown was seen as a baby Macquarie Bank.
I do remember that as well.
Yeah, no, I remember that too. I did have a Babcock and Brown fund as well, so never again. All right. Okay, so a no on Bubs. All right, let's get stuck into the stocks you suggested we have a look at. And James, Mike wants a view on Steadfast, the big insurance broking network here in Australia.
Yeah, look, it's effectively a bit of a roll-up model, as Ausbrokers are. They're pretty defensive earnings, but very, very moderate earnings growth, at least compared to Ausbrokers. Return on equity is not all that attractive. There's some improvements in the industry with rising rates is quite good for them. I can't see much organic growth, so you're really looking at acquisitions, and that's been the way that business has grown over time. I'm not particularly negative on it, but I wouldn't buy it. If I had to own one or the other, I'd own Ausbrokers, but I don't.
Right, okay.
Draw your own conclusions.
Adam?
Yeah, look, I don't mind this one. I mean, you can look at it on the chart there. It actually looks pretty good. It's sort of hit its new high and then sort of come back a little bit. So it is starting to move in the right direction. I actually don't mind this. They've got 220 brokers across the network. They do a lot of commercial motor and motor underwriting. So, I mean, that itself is quite large. They are one of the leading motor underwriters in Australia. So I think it actually looks pretty good. Sort of, James is right, the ROE is very anemic, sort of 14 and 15. So you look at that as a metric and you want something over 20. So that does mean that it's probably under earnings or that return on equity. So look, I actually think it looks good on the chart versus the business. I like Ausbrokers as well, but this one doesn't look too bad for me. So I'm going to say it's a buy.
Okay, all right. But your preference in the sector is
Ausbrokers.
Is Ausbrokers.
Yeah.
Sort of, do they benefit from this shift out of growth stocks and
Steadfast?
Yeah. Like the insurance companies, where Nathan Somasundaram likes IAG and some of the big, and QBE to a lesser extent, because he said they're so ugly, they're actually starting to look reasonably good in a rising interest rate environment. Do insurance brokers follow the same thematic as the big general insurers?
I would think so.
Right.
I would think so. You know, there is rising rates, and that's going to play out well for the sector.
Right.
Albeit off a pretty low base.
And you need to raise premiums as well.
That's
so
right.
that sort of picks things up.
Yeah, I would think so.
Yeah.
But the roll-up story, I think, is good. Like, I think that's sort of that industry has always been very fragmented, and then they're able to roll these things up, get that sort of scale. I think that sits well.
And the risk there's always been is that the two of them, who are the major players, would compete with each other for what they were paying for brokers. And that hasn't happened. They've both been fairly disciplined about it. The market's big enough for both of them, so well played for having that discipline. But that's always a risk in that sort of thing, as it is with childcare centres, Pacific Smiles and 1300 and all those sort of things.
Vets.
Good idea if you do it right.
Yes.
Okay. All right. Gary wants a view, Dawesy, on Credit Corp, the financial group that basically is like a factoring business. Takes over the loan books of big financial institutions and says, hey, we'll pay you 95 cents in the dollar and then we'll go and collect
the
all
rest.
The loans.
Yeah. Look, I've been a clear... I've been liking this one for a long time, and I still continue to do that because Credit Corp in Australia has done very well, and I think they bought their competitor's book. I think it was 6 months. It wasn't. No, it was
Baycorp.
Baycorp, that's it.
Baycorp,
so they bought that competitor's business and got it for a song, and that's the Australian side. But really, Credit Corp is looking for that US expansion, and that's exactly where I think that they're going to do very, very well, and that growth will continue, and that's going to be a fantastic opportunity for Credit Corp. So it's a buy from me.
Yeah, all right. Even at these levels, 31, it's had a really good run.
It's had a good pullback as well. So it was up, obviously 34s or 35s, and then pull back. So I think absolutely, and that shows the strength in the stock.
You've been a fan of it for a while, haven't you? I think you put it as I put it in my little super fund.
Yeah, I didn't get any brokerage for that.
Back around $15, so it went well.
We've done it, and we'll continue.
I owe you a lunch for that.
Oh, all right, done. Everybody heard that, yeah? Everybody heard that.
James, what do you think of Credit Corp?
I really like the business. It's a wonderful business. It's wonderful management. They're really, really disciplined. As you say, they buy distressed debt ledgers. They buy them for pennies in the dollar. They never disclosed what they actually pay, but it's widely thought to be about 15 cents in the dollar, and so anything they collect above that is gross profit. They operate on the absolute best practice of consumer advocacies. You never hear about them being in any sort of strife. They're not sending bikies with baseball bats.
No, it's very, very online driven, isn't it?
Well, what they do is they hire a lot of largely out-of-work actors and train them in the way they want to speak to their customers.
I didn't know that.
That's
out-of-work actors. There must be plenty of those.
There'd be plenty of them. Those types of people and who've got good communication skills. And they take a softly approach. They recognise that by the time you get into Credit Corp's hands, you've probably got other debts. And so they take a steady, soft approach. And it's been very successful over time. The main part of the success is that they don't, they're very disciplined, they don't overpay.
Right.
They're in the sweetest spot possible at the moment with their major competitors effectively out of the market.
Yeah.
And as Adam says, the growth in the US is fantastic. They set up a facility, if that's the word, in Salt Lake City, so that it sort of covers all the time zones quite easily.
Yeah.
And they've met every target on when it would be profitable, the rate of profitability, the rate of filling the seats. They're now opening up a second centre in the US.
Right.
The other part of the business is they've got consumer lending as well, and they've got a massive competitive advantage in that part of the business, in that they've got, in Australia alone, a database of 1 million people they won't lend to.
Wow.
So they
won't lend
to because they're not collecting in the collection business.
Yeah.
So if you're covering your losses in the lending business, that is a very, very big advantage in profitability. I really like the company. I just don't see the value there at the moment. I like it. I own it. But I think it's expensive. I think if you look forward sort of 5 years or whatever, you probably see that the stocks, you've done well buying it at these levels.
Yeah.
Right.
But I think that the pullback is from very, very high levels. It wouldn't surprise me if it pulled back a bit more. I love it. I'm not selling it, but I wouldn't be buying it unless it was a bit cheaper.
All right. Okay. Thank you for that, Gary. Alex wants a view now on another financial company. This one in a sort of bit sexier part of the market at the moment. Zip basically has been put into the buy now, pay later space, but is a bit more diverse as a financial market. But because they have a buy now, pay later arm, they're in a hot sector of the market.
Yeah, they are, and we've talked about this sector before. It's not one that I like. It's not profitable. I get that revenue across the sector is growing massively. People taking up the products growing massively. Losses are narrowing. I suppose that's a good thing. Mm-hmm. But there are 2,258 companies listed in the Australian market. Mm-hmm. How many are you going to have in your portfolio? 15, 20, 30?
Yeah.
Why wouldn't you have the best of the best? Why would you go and buy companies that aren't making money, that have got huge potential regulation, massive competitors around the world that are sort of out of that space but starting to get interested, PayPal for one. Look, I wish people well who own it, but there's no way I'd buy it.
Okay.
And I'm never going to get an afterpay. I'm never going to get a zero. I'm never with my approach.
Right.
And so that's fine. I'm very comfortable with that. But I'm not going to wake up one morning with, we mentioned Babcock and Brown before, these sort of, wonderful sounding companies that are so highly publicised and inflated in their thing, and then we wake up one day and it's all gone.
Right. Okay. Adam?
Well, I'm on the other side. I actually think Zip's a buy. I love it. I've been an advocate of the buy now, pay later sector for a long, long time. Just on the regulation side, certainly Zip has a higher level of regulation compared to Afterpay or some of the other buy now, pay laters. And if push came to shove, I think the ACCC would look at Zip favourably compared to a lot of the other ones, because they do at least 2 different credit checks before they put somebody on. The signing up, we know that Zip's got a quarterly that's coming up in 3 weeks' time. That quarterly is going to be absolutely fantastic. They're going to kill it, and we can see the share price over the last coming couple of days has started to move in anticipation of that quarterly that's coming out. We know QuadPay is beating Afterpay in the US as far as sign-ups and merchant sign-ups, and they're signing up, it's like a couple of thousand people a day, and merchants, a couple of hundred merchants a day. Like, it's ridiculous the amounts that they're serving up. The stock has been hit fairly hard with this tech sell-off that we've seen over the last coming couple of months. But what people don't really understand is that, yes, the share price has fallen, but Zip and Afterpay are basically doing what they do best, is getting out there, signing up merchants, signing up clients, and getting those things moving.
That QuadPay is growing rapidly. That was a good acquisition.
It was. And we thought they paid a little bit overs when they did to buy it, but it is absolutely steamrolling. So, yes, there are the issues about PayPal. There are the issues of these large, even the credit card companies have, I got a letter the other day, pay in 4 installments. They're trying to get to where these guys have been, and credit cards overall have been declining at a rapid rate. So they need to try to do something. But it's the new millennial people that don't, that use these services. And yes, they're not profitable. I totally agree with that. But the market is happy to pay for the potential of those earnings. And Afterpay is probably the best, because at 115, it got down to 89, 85 in the last sell-off, straight back up again. I think Zip is a better play, better business. It's a buy.
So you prefer this over Afterpay?
Yeah, I do.
Okay.
For that regulation side of things,
yeah.
I think that absolutely is a key. But also then QuadPay in the US is killing it, and basically.
So a couple of people have said to me that no one quite understands how successful QuadPay is becoming in the US, but it hasn't started to filter through yet.
And to the share price as well, because it's absolutely, and Zip's a funny one when you look at it, and I look at it on a daily basis, and we're trading it, but anytime it sort of sticks its head above that sort of $8, it just gets hit back down again. Yeah. So I think there is some selling in there that needs to get washed through. But I think this next quarterly, keep an eye on it, and it's a fantastic trade into that quarterly. I think you'll do very well.
Okay, so it's up 9% this morning. So it's had a bit of a bounce.
Yeah, so this is
above $8. So you're saying if it stays above $8, that will be a good sign for it. If it drops down again.
Well, no, it should. Fingers crossed, it should stay above that, because you're going to see this buying coming into that quarterly. Okay. So that's what the market's anticipating.
I completely get the growth in subscriber numbers. I just have it doesn't meet my approach. Yeah. So I'm not saying,
totally.
Alex, that it's not going to do well. It's just saying it doesn't suit my approach. I get the whole millennial thing.
Yeah.
While I'm sort of a few grey hairs, I'm not really a millennial.
What's wrong with grey hair?
Nothing wrong.
Have you got any problem with that?
No,
what's wrong with that?
I dye mine to make myself look more distinguished.
Right.
But I had a horrific thing the other day. I came into the office and for the first time ever forgot my phone. Right. Left my phone at home, and I couldn't tell you the last time I paid cash for anything. I just tapped the phone. And I rummaged around in my drawer at work and was fortunate I found a few coins, so I sort of went and paid for a coffee like my ancestors did.
I know, it's pretty weird, isn't it, at the moment? All right, thank you for that, Alex. Some good analysis there from both James and Adam. Dawesy, Sebastian wants a view on Magellan Global Fund, the big listed investment company managed by Magellan, of course, with a focus on international investing. One of their biggest, isn't it?
It is. Magellan has done a fantastic job of marketing. They've done a fantastic job of showing, and Hamish is definitely at the forefront of that moving forward. Most Australian investors are underweight international equities.
Yeah.
It's a known fact. Most self-managed super funds are underweight international equities. So for me, getting some of this global fund is a great way to get some access to some really good companies that are out there. And they've got Alphabet, Netflix, Facebook, Tencent, Microsoft, Alibaba, the names go on of a good quality. I do prefer buying MFG, which is the Magellan mothership, as it were, instead of the sub-funds.
Right.
Okay, because then any outperformance, and the outperformance on this MGF is actually quite expensive. I think it's a 10% outperformance fee over the MSCI index, and they're charging for that about 1.3% management fee as well, which would be lovely to get on a regular basis. So for the amount of billions of dollars of this thing, they're making some very good money going forward. So my preference is MFG, just like the Macquarie. You buy Macquarie, the mothership, you don't buy the sort of sub-funds, because they all have to pay up into that. But getting some international exposure in your portfolio, this is a really great way.
When you're talking about those sorts of fees, why wouldn't you invest in an ETF?
Agree.
With much lower fees, rather than a listed investment company like
So Hamish has...
Sorry.
No, go. Hamish has got a fantastic reputation in the market, and he has got consistent inflows coming into his funds. So that I think is important. He has been criticised for holding too much cash, and they have missed out on a fair bit of this upward swing. However, if you do look at it, the Aussie dollar is starting to come off a little bit. US dollar should rise. That is a benefit for these kind of global funds as well. So there's a couple of things. I
absolutely agree with everything that Adam says. The only couple of things that I'd add, number one, this over an ETF, they're a lot more targeted. An ETF you get a bit of everything. These guys, I don't know how many stocks they own, but it's, I think, maybe 3 dozen. The high conviction fund is 12 to 15.
Yeah, it's quite concentrated.
So you're getting the best of the best. Right. Now the risk with that is that if one of them underperforms, like Alibaba has, in that time, that it affects the overall thing. But if the business case for Alibaba stands up and they continue to hold it, that'll wash through over time. The other thing is, if you buy an ETF, you're paying $1 for $1's value. This is trading at an 8% discount. So you're buying Microsoft, Alphabet, blah, 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 at 92 cents in the dollar. Yeah. I think it is a fantastic and very easy way for Australians to get exposure internationally. But as Adam said, if I only had to own one, and I actually own both, I'd own the mothership.
Yeah.
Right.
Yep.
Okay.
But Sebastian, I have no problem with.
So it's a buy from both of us.
It's a buy from both of us.
It is a buy from both.
Absolutely.
Absolutely.
Okay.
But I think you do better in that MFG versus MGF.
You get more volatility,
Right.
but that which doesn't bother me. I see that as opportunity. Some people don't like it, but absolutely, Sebastian, I'd be. I think it's a fantastic.
Okay. All right. Thank you for that. Now, James, Simone wants a view on Flight Centre, the big travel agency that a lot of people put in their basket as an opening up sort of story, like all travel stocks has been absolutely hit heavily.
It's really hard for the sector, isn't it?
Yeah.
They're the first ones to go into losing business. They're going to be the last ones to come out and gaining business. So effectively, it's in care and maintenance. But it is a really, really good business that, through no fault of their own, has been taken away from them. In the meantime, they have done... Founder-led, absolutely. In the meantime, they have absolutely stripped costs out of it. They've closed underperforming branches. They've renegotiated leases. They've moved incredibly down the path of automating a lot of what they do. When they emerge, there's going to be enormous pent-up demand. And I suspect a lot of competitors will have gone by the wayside. Yeah. Now, unlike a factory that takes a long time and expense to retool it, you can open up a travel agency pretty quickly, but they will emerge to a much more streamlined cost structure, huge pent-up demand, and a less competitive environment. The question is, Simone, how long are you prepared to sit and have a company that's not earning any money? So my view is, if you are looking for something that's earning money now, paying dividends now, you probably don't want to be in Flight Centre. If you're taking a long-term view on capital growth and prepared to sort of buy it and bottom draw it for a bit, I think you do really well over time. But I have no visibility on what that time is. We're all hoping we're all going to be able to travel tomorrow. But
so in that clump, Webjet, Corporate Travel, Flight Centre. Is Flight Centre your preferred?
I'd probably have Corporate Travel as a preferred. Another founder-led company. They have. You'd think Corporate Travel will be a lot more. Will bounce back a lot more than leisure travel. Right. Okay. And of course, Flight Centre's got a big corporate travel business themselves. Yeah. But
and they moved into corporate travel about 6 months before this pandemic started. So we were going. We like that corporate travel side of it. They're moving into that. This is a great growth engine for them. And then obviously COVID happened. So you're about to ask me what I think about it.
Yeah. So you're saying...
I'd say yes, depending on your circumstances.
Yep.
I don't know Simone's circumstances.
Yep.
And by this is no advice.
Yep.
We never take into any consideration any personal circumstances.
General advice only.
General advice only. So look, you think for Flight Centre, you've got to look at potentially what Qantas is doing and how their travel plans are moving to then to potentially wind that back to something like a Flight Centre. Now, Qantas has basically said to the market that they're up to 95% capacity for their domestic travel at the moment, okay? And New Zealand, opening up the bubble, as it were, is steadily growing as well, or rebuilding steadily at the moment. So look, it looks like that potentially Qantas is doing well in that domestic capacity, but the problem is with Flight Centre, they are the ones that book these big packages to Fiji, to South Pacific, to America, to Europe, and there's none of that whatsoever at the moment.
Yep.
The other side of it is, remember that Flight Centre had to raise their whole entire market cap again at around about $9, $6, something like that at the bottom end of the pandemic, because they weren't making any money and they had to survive. Yes, they've cut costs, they've taken buildings out, all these kinds of things. So the stock usually trades around a $40 sort of, it used to trade around $40. It now trades at $17. And that basically means that as they had to raise their whole entire market cap again, that $20 is the new $40. So you've got to be really careful, okay?
Yes.
Because the whole entire market cap has been raised again. That potentially means there's a bit of headwind around that $20 mark, and we've seen that a couple of times where Flight Centre's picked up to 20 and then got sold off fairly quickly.
Yeah.
So don't look at the chart as in a whole, because it is very different, because they've had to raise their whole entire capital again. So just be careful, I think, with looking at that, because it's a fantastic business and a fantastic chart, but the new normal.
What you're saying is, yes, it's 16, and you can be going, I'd love 68.
Correct.
But that 16 is really 32.
Correct.
Compared with
dilution and extra market shares and market cap there. So trap for young players is you look at this chart and you think, oh, geez, it can go to $60, $65. I'll buy some. It looks cheap at 15. But actually it's not. It's the sort of the new normal. So for me, it's a hold. If you've got it and you haven't sold it, you're pretty much going to keep holding this. There are some people that some of my clients that got in at the $10 mark and they're quite happy. They're happy shareholders of it down there. I just think that if you wanted to play that travel opening, Qantas is probably the first one or the sharpest one that you look at, because they're the ones that are going to show us the travel details, the flights and how they're working. And then it will go into potentially the airports, Sydney airports, and then it will come into the flight centres or the package holidays and those kind of travel agencies. Okay. So that's how I'm playing.
So that whole travel thing, Qantas would be your...
Well, yeah, it's the first. It will be the first one to move.
And the interesting thing is Qantas, its domestic business has always been the most profitable, hasn't it? International.
Absolutely.
Hasn't made it much
money,
a lot of prestige.
That's right.
So
but when
the frequent flyer program that's the most profitable.
Is very profitable.
Yeah.
So I just think that if you're going to play it, hold it. Definitely hold it if you've got it. But there's probably other places to play that reopening trade.
Right.
Casinos is a great way to play the reopening trade. I mean, there's plenty of other areas that you can look at before you get to the flight centres of the world.
Okay. All right. Let's just recap first 5 stock of the day. Bubs a no from both Adam and James. Steadfast a no from James. A yes from Adam, but both of them prefer Ausbrokers in that space. Credit Corp a no based on its big run up from James. A yes from Adam. Both. So it's an incredibly well-run company. Zip a no from James, a yes from Adam. Magellan Global, a yes from both, but they would prefer you go into the fund management group rather than their individual funds, because the funds manager itself gets all of the fees from funds like the Global Fund. And Flight Centre, a yes only if you're investing for the long term from James. A hold from Dawsey, who prefers Qantas in that whole opening and up travel sector. Here on the call, we've been tracking our own fantasy portfolio since the 1st of July last year, thanks to our partner NABTrade. Any stocks that get 2 thumbs up, like Magellan Global Fund, goes into the calls fantasy portfolio. If it comes up in front of even a different expert panel in the future and doesn't get the unanimous thumbs up, it then goes out. Let's see how we're going for the week. Down 0.5%, for the month up 5%, up almost 34% since the 1st of July.
It's well done. Good on the year to date.
Right.
Yeah.
Stocks recently added: Domino's, the L1 long short fund, RPM Global, Ramsay Healthcare, Medical Developments, and Janison Education. Some of the stocks removed by our expert panel recently: Whisper, Bravura, and Home Consortium. If you want to take a look at all the stocks and ETFs in the calls portfolio, go to ausbiz.co/portfolio. And coming up next on The Pulse, straight after the call, Michael White from New Brighton Capital. He's taking us through SMSF obligations when it comes to cryptocurrency. That would go into the high risk end of your strategy document that you put towards your auditors. Mike is coming up at 1:10 p.m. Eastern. Either of you in cryptos?
No, I get asked 3 times a day about it, but
I
no,
know.
I've been asked once in my since the whole thing started. No, I'm not.
Okay.
I'm definitely with Charlie Munger on the cryptos.
Yep, yeah. All right. All right, let's get into our second 5 stocks. And Luke wants a view, James, on Imdex. Now, this is sort of a mining services company, isn't it, that goes out and drills exploration holes and provides the equipment and the fluids.
It does, but it also does geological mapping and mineral testing and all sorts of things. Look, it's been listed since 1987. It's had a variable history of profitability. Return on equity currently slightly above 10%, which is really the minimum that you'd find attractive. It's been higher in the past, it's been lower in the past. They've had profitable and unprofitable years. I go back to what I was saying before about if you're going to have 20 stocks, even 30 stocks in your portfolio, why would you have this one? And it looks a bit expensive, pretty fully valued. I don't know the business well, so I don't put out myself as an expert on it, but not for me.
Okay. Is it one of those cyclical stocks that follows the commodities boom? Like if there's a commodities boom and a commodity super cycle, as everyone's saying at the moment, that there's going to be no end to it, I suppose more people go out and explore and would use their services.
Absolutely, and that's one of, I guess, the key things. And I'm not a fan of this one at all. So, but I guess I'm just going to talk to what the outlook for the earnings are going forward, and there certainly is that supportive commodities pricing. That's exactly what happens. But the problem is commodities are cyclical, and we're at potentially the clock's at 11 o'clock at the moment on the investment side of things, and potentially that we might see a pullback in commodities in the next medium term. Obviously going forward, strong results in global drillers as well as increased exploration forecasts for all the majors going forward. IMD's done an interesting one where they're renting a lot of their tools and instruments, and so that's seen some growth going forward. Shown a little bit different from some of the other guys. But look, I don't like this sector because it is so cyclical, and it's looking pretty good at the moment.
5-year high at the moment. That's that sentiment for the
sector.
For the boom, the sector, is that?
Yeah.
If you're not in the resources sector and you're not in the 5-year high at the moment, you're doing something wrong.
Right. Yeah.
Absolutely. So it's a no from me. There's better places.
All right.
Yeah.
So that leads me to say, if you're saying that it's at 11 o'clock, are you suggesting to clients that they take profits on their resource stocks?
We've definitely taken some money off the table on BHP, Rio and Fortescue, and it's what our analyst is calling fade the rally, but he's been talking about that fading that rally for a while now. I don't think that overall commodities are going to fall anywhere. It's not going to fall away. However, I do feel that iron ore at sort of 200, copper, and we've seen copper come off a little bit over the last couple of days. The only thing that's going to offset all of these commodities falling is going to be the Aussie dollar falling. Right. And if we see the Aussie dollar falling, it's going to be a net, and it's going to be positive for the resources going forward. Right. So that's my only thing. But yeah, look, certainly taking some money off BHP closer to $50, Rio at 120, Fortescue at 25. It's probably not a bad idea just to pull back a little bit at the moment.
Yeah, I 100% agree with that. I generally don't like the resources sector a lot because it's highly capital intensive and complete price takers and cyclical. That's not to say, I don't have clients that own the majors, but if you were of a trading bent here, I'd be taking some earnings off. And the other thing is, particularly with iron ore, at some point in time, that party's going to stop, and it's going to stop badly. The Chinese are investing huge money in infrastructure, rail, port, in West Africa, and we're going to wake up one day and it's going to be like barley and treasury wine and all those other things and lobsters and whatever else. Yeah. So
that's with a sort of a 5-year view, though. Yeah?
Correct, absolutely.
That's
exactly what I was going to say. It's not going to happen immediately, but as it becomes more of a risk and more on the market's radar, these stocks will start to underperform, really because of the threat of that being out there, and you look at a Fortescue, it's absolutely booming at the moment, and iron ore at $200 a tonne, they're not getting premium, they don't have the premium fines, it's trading on 8 times earnings. Mm-hmm. So that either tells you that it is ridiculously cheap. Or that it's cyclical and it's at the top of the cycle, and I'd be on the second view.
11% dividend.
Yeah, that's pretty good. The other thing though, especially in China at the moment, steel production is quite seasonal, and we're at the top end of that seasonal production in China. Right. Just to give you some numbers on that steel production, China is producing around 3.5 million tonnes of steel a month. Now, to put that into perspective, BlueScope, port in Newcastle, produces 11.5 million tonnes a year. Right? So these guys are absolutely full metal to the pedal to the wall to produce as much steel, because it is seasonal and we're at the top end of that season. So that means that steel production might pull back over the next coming couple of months. Yeah. That means the iron ore price might be a little bit soggy. That means that our resource stocks might come off just for the short term in there as well. So it's still going very, very strong at the moment.
I reckon Josh Frydenberg and the boffins in Treasury are cheering it to stay on.
Oh, absolutely.
We've saved our country.
Koshi.
Even, they had $50 a tonne for this current financial year's budget. Next year they put up to 80, I think.
Something like that.
It's still 200, so it's his little slush fund.
But
as I
if
put to him, he gets very offended by it. Right? Well, you've got the iron ore slush fund, don't you?
Well, if we're not paying down debt and using it to fund infrastructure and things, rather than giving everyone a tax cut for a new television or car, we are
I think that's
shooting ourselves in the foot.
And the other, with those job figures coming out yesterday as well, with job creation, he was telling me that as a general rule of thumb, 200,000 jobs created adds $5 billion to the budget bottom line.
Wow.
So that's because you have that amount of people coming off welfare support
It's a double
and
effect,
paying
isn't it?
tax.
Yep, absolutely.
That's
$5 billion.
I thought he just dropped that in an interview that I did with him, and I thought, that's a really catchy
I'll use that one
to actually know.
Yeah,
all right, let's move on.
Right.
Matt wants a view on Integrated Research, the computer company. Look, I'm not actually sure what it does too much, but it's in 60 countries. Sales of USA, UK, Germany, Singapore, Australia. Through it does big end of town computer networks.
So it's a no from me. The one, it's illiquid, and two, if you look, we'll look at the chart in a second. It's actually below post-COVID or post-COVID lows. Yep, that's what I'm trying to say. This thing is in a bit of trouble at the moment. For me, it's a no. We'll move on with that one.
James?
I own it, and it is the standout underperformer in my portfolio. And what they do is they have diagnostic software for critical IT systems. Right. And it's really interesting. They're in 1,000 companies in 60 different countries, and yet their revenue is only 100 million. Right. So what that suggests to me, but it tends to be really sticky. These customers have been there a long, long time.
Because they're big end of town people in government.
Absolutely. Big banks and telecommunication companies and stock exchanges and so forth.
Payment systems.
All that sort of stuff. It alerts them when there's an IT problem, a computer problem, so they can get on top of it. It doesn't fix it. The fact that they've only got 100 million in revenue suggests to me that it's not a big enough spend in any of these companies for the directors to look at it and say, gee, we can save some money by developing this in-house. Right. So it should be a lot stickier. I had a view 12 months ago, and I've clearly been wrong, that I couldn't see where they'd lose a cent in revenue through COVID. But they've had contract delays, they've had renewal delays, renewals at lower levels, they've had delays in revenue recognition. It's very, very frustrating. To me, it should be really good, but I'm nervous. I like it when you get a really, really good company that stubbed its toe and you can say, this is a short-term thing, market's panicking, let's let's sort of pile in while it's so out of favour. I don't have that confidence with this business because I can't see why they should have lost any revenue through COVID. It's not a consumer stock. So I don't know. I own it. My guess is I think it's good value.
It's heading towards 5-year lows there on that chart.
But I'm nervous about it.
Okay. So, yes or no?
I'm not generally a punter, but for this one I'll say yes. But it's not going to go in because Adam's a clear no, so it's not going to go in anyway.
Hedge your bets there,
Big punt. All right.
No, I'm not hedging my bets. I'm saying yes.
Yes.
But I don't know when they can turn around.
All right.
You look at that.
But you look at the quality of their customers and the stickiness they've had of them over time. I'm going to have a bit of a punt, but it's not something you're going to commit a big part of your portfolio to.
Okay, high risk area. All right, Ripon wants a view on Dubber Corporation, James. Again, another software as a service, but in call recording and audio messaging.
Yep, all that sort of stuff. It should be a really growing business. Look, been listed for 22 years, and it seems to me their major achievement is issuing more capital. Right. They've gone from 3 million shares 10 years ago to 256 million now, including a 5-for-1 consolidation. Right. It's not making money. Rip on if you know something about it and think you know something about it and want to have a play, good luck to you, but it's not one that I would touch.
Adam?
We're going to disagree on this one as well. I think it's a buy.
You probably know the business more than me.
Yeah,
I do not know the business in depth.
So we cover it at Shaw's. Look, it's a very interesting business, and I saw them when they first basically brought this business in because I really couldn't understand voice recordings, and until I had to get something with a credit card, and I had to get my voice recording back because they didn't believe what I'd said. Right. It took 3 months for them to get that voice recording back to us to check that what I'd said was correct, and then they rebated the money or did all that kind of stuff. With Dubber, it's all on a cloud-based service, and they can pick it up within 3 minutes and get that recording back to the person when you do your voice recording and those kinds of things.
So when you ring someone up and say your call is being recorded,
that's correct. So this is the technology that sits over the top of that, and what they've done is they've just put it in what is called a foundation agreement, which is basically putting these big, large companies into that on a global basis. Now, Cisco is the first company to put this to get this across their entire network and this controlling. So there is more reoccurring revenue or annual ARR, annual reoccurring revenue going forward, and it is a SaaS business. It's one of the highest growth profile SaaS businesses on the ASX. So I think this is a really good business. It's got an interesting side of it. There's further catalysts to come on this one. It's a buy from me.
Okay,
really
even though it's
so why do they make money?
It's a 5-year high.
So how do they make money?
Why don't they make money?
Well, so there's 222 million of annualised revenue coming in there at the moment. So need to sign more of these big Cisco clients to get that overall movement going through. Because I think they did Virgin, they did Telstra, so they've got some big ones in there, but they need more of those guys to come in. And as every SaaS business comes in, you build the platform, and then everything else on top of it is just cream. So that's the kind of thing we're at. And I think the market is probably overpaying at the moment, like to your point, Koshi, at $3, looking to overpay a little bit. We have a current price target of $3.23 on it, so I think it's fair value here. Right. But if they can continue to get some of those bigger contracts, I think you'll see the price moving forward.
All right. Fran wants a view on James Hardie, the big building materials and group, not only here but also in the United States.
Yeah, I mean, the US has been their biggest thing going forward. I mean,
and they've done it well.
And they've done it well. The only thing that I can think of that is probably going to hurt James Hardie going forward, because I think it's a buy. I think it's a great business, and should do well within that overall US expansion. It's the cost of their products or cost of those products coming in. Those materials are going high. We are seeing inflation in a lot of these commodities that they use.
And
now.
They pointed that out in their trading update recently, didn't they? They said they're both labour costs and suppliers.
So they have to get more cost savings out of the business. But look at that chart. I mean, you just can't ignore it. It is doing very well. And in the US, obviously, if we see the Aussie dollar starting to pull back a little bit, again, that's a positive. So look, I think this one is, you've got the other ones. You've got Boral and you've got Adelaide Brighton, those kinds of things. But I like the US focus that they've got on this one, so it's a buy from me.
Because Boral's stuffed up the US and is trying to get out of it.
Imagine the surprise.
Yeah. But these guys have done it well.
They've done it really well.
Yeah.
Look, it's a company with a checkered history, but a wonderful present.
Yeah.
And we all know the history of it. They've been fantastic in their move to the US, and the US housing's booming in new houses, in remodelling. The size of houses is growing, so they're all using more of Hardie's products. And Hardie are moving people up the value chain from the cement to Hardie plank, Sem plank to Hardie plank cladding. It's in a real sweet spot at the moment, and Adam's right about the possibility of a currency tailwind. Return on equity is fantastic. Debt's been coming down steadily. That's all great. I just think it is cyclical, and it's pretty expensive. I like it, but I wouldn't be buying at these levels.
Okay, so you have it as a whole?
Yeah.
Yep. Okay. All right, and our final stock.
This is a good one.
Linus, we kept this to last because this is a good one. This is Foslock Environment Technologies.
How much time have we got, Koshy?
Linus says has been in a trading halt since September last year. Could the panel indicate what they believe will happen to the share price, upwards or downwards, when the company eventually resumes trading on the ASX? Now, they're in clean water, environmental.
Correct.
They basically clean up polluted waterways.
Algae and all that sort of stuff.
And any leakage from chemical plants. Had a big story of getting into China, which you immediately think, with their pollution, the greening of China, that Foslock would be a beneficiary, but they had issues.
I'll start then. Okay, so in answer to the question, what is going to happen to the share price if it does list again? It is going to fall. It is going to get absolutely belted. Potentially there's an opportunity there for the people who are willing to and are happy to take the high risk. But basically Foslock's technology is, when you put in a bath, you put those fuzzy, those balls.
Right,
and that's what it does. It foams up and it cleans all of that stuff off. And the technology started on golf courses because they put a lot of phosphate and they put a lot of chemicals onto the grass. Okay. And then that phosphate, when it rains, goes into the waterways, into the ponds, and starts to get algae, and they can't have the algae on a nice golf course. So they've found this technology, put all these bath balls in there, it fizzes up and it takes all of the algae and the waste out of it. And it can be as clean as drinking water. Fantastic idea. But the problem is with this one is that the directors were embezzling money into the business, or out of the business, and it basically irreversible from where it is at the moment. And the new chairman has come in, they got rid of the old management, the new chairman's come in, and in fact at their AGM in May this year, it was his 12-month anniversary, and the stock has not come back on. So they've identified there's legal action that's going to happen on the directors that have actually been embezzling money. That's going to happen. They still need to work on a lot of the China stuff going forward. And if they can, execute a sustainable growth plan going forward, this business might have a chance. But in the meantime, in answer to your question, it is going to get hit very, very hard, and I would be very, very cautious about going into this one when it does relist.
James?
So, fraud in their Chinese business. What's not to like about it? Yeah, Adam's right. I can't add to that.
Yep.
It's.
Is it one of those stocks that can you get rid of it before June 30 if you've made money elsewhere?
So there's a website called delisted.com.au. You can go on to that, and then from there, and I think it has to be unlisted or delisted for 3 years.
Right.
There's a letter that you can get from the company to say that your shares are absolutely worth zero. And that's your tax, you sign off on that, and then you can use that.
And that looks unlikely. Look at the comments at the AGM.
Correct.
They are, the business is not dead. They are selling more fuzzy balls or whatever the hell they are.
Yeah.
But it's such a bad look for a company to have.
It's horrible.
Absolutely.
Yeah.
All right, let's recap the final 5 stocks after Adam Dawes has actually confessed that he takes lots of bubble baths by the sound of it.
With candles, dusk. Yeah.
Excellent. Dusk candles, that's right. That's another one of yours.
I know. Yeah.
Imdex a no, Integrated Research a no from Adam, a punt from James, but a big punt. He owns shares in it and has run it down. Dubber a no from James, a yes from Adam, but if it can have a bit of a pullback, that would make it even better. James Hardy, a yes from Adam, a hold from James, and Foslock, no.
Well, it's not trading.
Bit
so
of pain. Yeah. All right, James Rosenberg from Baillieu, good to see you.
Good to see you, Dave.
Always great to see you.
Thank you.
Oh, both of you in fine form on a Friday. And if you'd like any stocks to cover on your behalf, put them in an email to us, the call at ausbiz.com.au, or through Twitter using the Ausbiz TV handle. Reminder, all the stocks in the calls portfolio at ausbiz.co/portfolio. And don't forget to subscribe to the Ausbiz newsletter if you want to wrap up each day of what's been happening. Get Scuddy's View, the COB podcast, and popular videos. Links there. Subscribe ausbiz.co/the COB.
Before we go, who was leading at the end?
I think you did, James. Definitely.
Very good.
I don't know about that.
It was
That's
a
very generous of you.
close run race. It was great analysis. Coming up next, Anto Joseph from Strop Pro joins us to take us through the investment opportunities in structured products. That's from 1:30 here on Ausbiz. And so there is a lot happening here on Ausbiz throughout the afternoon. We will return after this.
After a period of